Welcome, and thank you for attending KPMG's podcast on ASU 2013-05 on foreign currency matters. This podcast will provide a high-level summary of the ASU, which addresses the parent's accounting for the cumulative translation adjustment upon both derecognition of subsidiaries or groups of assets that reside within a foreign entity and of derecognition events on investments directly in a foreign entity. The proposed amendments would also affect the partial sale of an equity method investment that is a foreign entity, and it would impact entities that acquire businesses in stages, also known as step acquisitions. Now, the sale of an in-substance real estate and conveyance of oil and gas mineral rights would be excluded from the scope of this ASU. One thing to point out before we jump into the updates in the standard is that the ASU does not modify or provide any further guidance on the definition of a foreign entity. However, the guidance provides for significantly different accounting for transactions at a foreign entity level versus those transactions that reside within a foreign entity. So it is very important that before an entity applies this ASU, you should first have a clear understanding of what entities or groups of assets or operations within the structure meet the definition of a foreign entity as defined in Topic 830. My name is Dexter Midcap, and I am a Senior Manager in KPMG's Department of Professional Practice. The simplified organizational chart on this slide is presented to help illustrate the different levels within an organization at which this ASU addresses. Here we have a parent company that holds an investment in consolidated foreign entity and an investment in an equity method investment that also is a foreign entity. The consolidated foreign entity has an investment in a subsidiary and an investment in a group of assets that is a not-for-profit activity or a business. The consolidated financial statements of the parent company would contain CTA related to both the foreign entities and the subsidiary and groups of assets within the consolidated foreign entity. At the bottom of the org chart, with subsidiaries and groups of assets within a foreign entity, is the level at which the original issue was brought to the task force's attention. And that is, should CTA be reclassified into earnings upon the sale or transfer of a subsidiary or a group of assets that reside within a foreign entity and are not themselves foreign entities. The scope of this issue was later expanded to address transactions at the foreign entity level, including transactions that result in a loss of controlling financial interests in a consolidated foreign entity, partial sale of an equity method investment that is a foreign entity, and step acquisitions of a foreign entity. ASC Topic 830 only addresses the treatment of CTA at the foreign entity level, and it identifies two types of events that will result in CTA being reclassified into earnings, and that is one upon the sale of an investment in a foreign entity or upon complete or substantially complete liquidation of an investment in a foreign entity. ASC Topic 810 does not specifically address foreign operations or the proper treatment for cumulative translation adjustments, but Topic 810 does address the accounting for decreases in financial interest of a subsidiary and a group of assets that are not-for-profit activities or business. Topic 810 requires the carrying amount of a subsidiary be deconsolidated or a group of assets be derecognized upon loss of controlling financial interest. Although ASC Topic 810 does not specifically address foreign operations, an uncodified paragraph in FAS 160 stated that upon loss of control of a subsidiary, the amount of equity to be derecognized includes the amount previously recognized in OCI, which many have interpreted that to include the cumulative translation adjustment. Now let's take a look at an example. Here's a scenario where a parent company owns 100% of a subsidiary through its investment in a consolidated foreign entity. Let's say the parent sells or loses a controlling financial interest in the subsidiary that resides within the consolidated foreign entity. The guidance in Topic 810 will require the parent to deconsolidate the subsidiary, including any amounts in OCI, and thus the parent would reclassify all CTA related to the subsidiary into earnings as part of the gain or loss on the transaction. However, ASC Topic 830 states that no CTA will be reclassified into earnings unless the sale or loss of control of the subsidiary represented a complete or substantially complete liquidation of the parent company's investment in the foreign entity. The task force concluded that when evaluating transactions within a foreign entity, the guidance in Topic 830 should be applied, and thus CTA would not be reclassified into earnings upon sale or transfer of a subsidiary within a foreign entity unless that sale or transfer represented a complete or substantially complete liquidation of the foreign entity. The task force also concluded that groups of assets that are not-for-profit activities or business should be accounted for in the same manner as subsidiaries. Now let's take a look at a transaction at the foreign entity level. In this example, the parent sells 80% of the consolidated foreign entity, representing a loss of control. For transactions at the foreign entity level, the task force concluded that ASC Topic 810 should apply, and thus the parent company would deconsolidate the foreign entity upon loss of control and financial interest, and all CTA related to that foreign entity would be reclassified into earnings. This update also addresses the meaning of the word sale as contemplated in Topic 830. As noted in Topic 830, the sale of an investment in a foreign entity is an event that would trigger reclassification of CTA into earnings. Under Topic 810, a loss of control and financial interest is an event that would trigger reclassification of CTA into earnings. So the task force concluded that the loss of control and financial interest should be treated as a sale under Topic 830 and should be done so irrespective of any retained investment. Meaning, if one entity sold an 80% interest in an investment in a foreign entity and retained the remaining 20% interest, and another entity lost control and financial interest of its investment in a foreign entity, say due to a legal reorganization or bankruptcy, but still retained a 100% financial interest, both of those events will be treated as a sale under Topic 830 because both events resulted in a loss of control. And thus CTA would be reclassified into earnings as part of the recognition of gain or loss on deconsolidation of the foreign entity. This ASU also addresses partial sales of equity method investments and step acquisitions involving foreign entities. Topic 830 will continue to apply to partial sales of equity method investments which require a pro rata allocation of the CTA to be reclassified into earnings. The task force concluded that for step acquisitions, that they represent two events, the sale of an equity method investment and then the simultaneous acquisition of a controlling financial interest in a foreign entity. And thus CTA related to the equity method investment should be reclassified into earnings upon disposition of the original equity method investment. The updates in this ASU are applied prospectively to fiscal years and interim periods within those years, beginning after December 15, 2013 for public entities, and for fiscal years beginning after December 15, 2014 for non-public entities. Early adoption is permitted, and no additional disclosures are required by this update beyond those disclosure requirements that are already required for accounting changes under Topic 250. Thank you for attending this podcast, and we look forward to providing you with updates on other FASB and EITF projects.